Welcome to Lesson 6, Forex Trading Terminology. Today we will delve into the core jargon used in the world of Forex trading. Our journey will take us through 7 key concepts that form the backbone of this dynamic marketplace. We will start with major and minor currencies, exploring their unique characteristics and role in the global economic landscape. Then we'll venture into the realm of base and quote currencies, understanding their significance in currency pair trading. Our exploration continues with pips and pipettes, the basic units of price movement. We will then decipher the meaning of bid, ask, and spread, followed by an explanation of transaction costs and quote convention. We'll also touch upon cross-currency pairs and their distinctive trading characteristics. Finally, we'll demystify margins and leverage, essential tools for amplifying trading capacity. So, without further ado, let's embark on this educative journey. The Forex market is a hub of different currencies, but they are not all equal. In the bustling market of Forex, currencies are usually categorized into 2 broad types, major and minor, or exotic currencies. Major currencies are those that originate from the world's most powerful economies. The US dollar, the euro, the British pound, and the Japanese yen, among others, fall into this category. These currencies are known for their stability and high liquidity, which means they're easily bought and sold without causing significant price fluctuations. They're the backbone of the Forex market, and most of the trading activity revolves around them. On the other hand, we have minor or exotic currencies. These come from emerging or smaller economies like the South African rand or the Mexican peso. These currencies are typically characterized by less liquidity and greater volatility. In simpler terms, they're not as easily bought and sold as their major counterparts, and their value can change rapidly and unpredictably. Now you might be wondering, why would anyone trade with these riskier, less stable currencies? Well, the answer lies in their potential for high returns. The greater volatility of minor currencies can mean larger price movements, and therefore higher profits if traded wisely. But remember, with greater potential for returns comes increased risk. To make the most of these currencies, it's crucial to understand their unique characteristics. Major currencies, with their stability and high liquidity, are suitable for beginners and conservative traders. They offer a safer, albeit slower path to potential profits. On the other hand, minor currencies, with their greater volatility, can offer exciting opportunities for seasoned traders who understand the risks and have strategies to mitigate them. In essence, the Forex market is like a bustling bazaar, teeming with different currencies, each with its own characteristics and charm. As a trader, your task is to understand these characteristics, assess the risks and rewards they bring, and select the ones that best fit your trading style and goals. Understanding these currencies is key to navigating the Forex landscape. In Forex trading, it's crucial to understand the concept of base and quote currencies. So let's dive right into it. When you look at any Forex pair, you'll notice it's made up of 2 currencies. The first one listed is the base currency, and the second one is the quote currency. Easy, right? But what does that mean? Let's break it down. The base currency is essentially the benchmark. It's the currency you are buying or selling. For example, if you go long on EUR/USD, you're buying euros and selling dollars. Conversely, if you go short, you're selling euros and buying dollars. The base currency, in essence, dictates the direction of your trade. Now let's talk about the quote currency. This is where pricing comes into play. The quote currency tells you how much of it you need to buy 1 unit of the base currency. In our EUR/USD example, if the rate is 1.15, it means you need 1.15 US dollars to buy 1 euro. The quote currency is the one that sets the price. Remember, the base currency is your starting point, your reference, your guide. It's what you're trading. It's like being at the wheel of a car. You're in control of where it goes. The quote currency, on the other hand, is like the road you're on. It sets the conditions and the cost of your journey. And just like with driving, understanding these 2 concepts is fundamental for navigating the Forex market. The base and quote currencies are the compass and map of your trading expedition. They guide your decisions and shape your strategies. So let's recap. The base currency is the one you're buying or selling, and it dictates the direction of the trade. The quote currency, on the other hand, sets the price for the trade. It tells you how much of it you need to buy 1 unit of the base currency. It's the measure of your investment. Remember, the base currency dictates the direction and the quote currency sets the price. The Forex market speaks a language of its own, and pips and pipettes are part of its vocabulary. Imagine trading in the Forex market as a journey across a landscape. On this journey, the changes in terrain represent the fluctuations in currency prices. Now, to navigate this terrain, we need units of measurement, and in the world of Forex, these units are known as pips and pipettes. Let's start with pips. A pip, which stands for point in percentage, is the smallest unit of measurement used to express the change in value between two currencies. Typically, a pip is the fourth decimal place in most currency pairs. For example, if the EUR-USD pair moves from 1.1050 to 1.1051, that's a 1 pip movement. Now, what if we need to measure even smaller changes in currency prices? That's where pipettes come into play. Pipettes are a fraction of a pip, and they provide an even finer measurement of price movement. Typically, a pipette is the fifth decimal place in a currency pair. So, if the EUR-USD pair moves from 1.10510 to 1.10512, that's a 2 pipette movement. Why are pips and pipettes important, you might ask? Well, they are crucial for traders because they help calculate the profit or loss from a trade. For example, if a trader buys the EUR-USD pair at 1.1050 and sells it at 1.1055, the difference of 5 pips represents the trader's profit. Understanding pips and pipettes can also help traders manage their risk. By determining the number of pips a trader is willing to risk, they can set their stop loss and take profit levels accordingly. So, as we navigate the fluctuating landscape of Forex trading, pips and pipettes act as our compass, helping us measure the distance we've traveled, the gains we've made, and the risks we've taken. With pips and pipettes, we can accurately measure and express price movement in the Forex market. In the Forex market, the terms bid, ask, and spread hold significant importance. Let's start with the bid price. This is the highest price that a buyer is willing to pay for a currency pair. In other words, it's the price at which you, as a trader, can sell your base currency. Picture a bustling marketplace, where a buyer shouts out their bid for an item. It's a bit like that, but in the digital world of Forex trading. Now, let's move on to the ask price. This is the lowest price a seller is willing to accept for a currency pair. It's the price at which you can buy your base currency. Think of the ask price as the seller's opening offer in a negotiation. They're asking for this price, and it's up to the buyer to either accept or negotiate. Now, you might be wondering, what if there's a difference between the bid and the ask price? Well, that's where the spread comes in. The spread is the difference between the bid price and the ask price. It represents the cost of trading on the Forex market. It's a bit like a transaction fee, but it's built right into the trading process. Traders aim for a smaller spread because it means they can start making a profit with a smaller price movement. A larger spread, on the other hand, means you'll need a bigger price movement just to break even. But here's the thing, the spread isn't just a cost to be minimized. It also reflects the liquidity and volatility of the currency pair you're trading. A smaller spread typically indicates a more liquid, less volatile market. Conversely, a larger spread may suggest less liquidity and higher volatility. So in essence, the bid price is what you can sell for, the ask price is what you can buy for, and the spread is the cost of doing business in the Forex market. Understanding these terms is crucial to setting effective trading parameters. Forex trading comes with its costs, and it's important to understand how they work. As a trader, whenever you enter a trade, you're faced with transaction costs. These costs are not separate charges that you pay to your broker. Instead, they're subtly incorporated within the spread. The spread, if you recall, is the difference between the bid and the ask price. This difference represents the transaction cost. It's the price you pay to play the game. The wider the spread, the higher your transaction cost, and vice versa. This is why, as a trader, you generally prefer currency pairs with tighter spreads. It's like shopping around for the best deal. Now you might wonder, why are these costs hidden within the spread? Well, it's not exactly hidden, it's just the way the Forex market operates. The brokers provide you with a platform to trade, and in return, they earn through the spread. It's their way of making a living, much like how a retailer adds a markup to the goods they sell. Now let's move on to the quote convention. In the Forex market, prices are quoted in a specific format. A quote typically consists of the currency pair followed by two prices, the bid and the ask. For example, if you see EUR-USD quoted as 1, 2050.55, it means that the bid price is 1.2050 and the ask price is 1.2055. It's crucial to remember that the bid price is always lower than the ask price. The bid is the price at which you can sell the base currency, while the ask is the price at which you can buy it. The difference between these two prices is, as we've discussed, the spread or the transaction cost. Being aware of these costs and conventions helps in making informed trading decisions. By understanding how transaction costs work and how prices are quoted, you're better equipped to interpret market information and make smart trading choices. Remember, knowledge is power in the world of Forex trading. Cross-currency pairs offer unique trading opportunities in Forex. These pairs, unlike the major currency pairs, do not include the US dollar. They are called cross pairs because back in the day, if an investor wanted to exchange a sum of money into a different currency, they first had to convert it into US dollars. However, with the advent of cross-currency pairs, that extra step is no longer necessary. Cross-currency pairs typically involve major currencies outside of the US dollar, such as the euro, Japanese yen, or the British pound. Some popular examples include EUR-GBP, EUR-JPY, or GBP-JPY. These pairs offer the chance to diversify one's trading strategy, as they may behave differently from pairs that involve the US dollar. However, it's crucial to note that while cross-currency pairs offer unique opportunities, they also come with their own set of challenges. One of these is liquidity. Cross pairs tend to be less liquid than the major pairs, which means they may not be as easy to buy and sell. This lower liquidity can lead to wider spreads, which are the difference between the bid and ask price. Wider spreads often translate into higher transaction costs. This is because the spread is essentially the fee that your broker charges for executing the trade. The wider the spread, the more you'll need the market to move in your favor just to break even, but don't let this deter you. Trading cross-currency pairs can still be a profitable venture if navigated with care. They can exhibit unique trends and volatility patterns that can be advantageous to the discerning trader. Moreover, these pairs can provide exposure to specific economies, allowing for strategic trades based on economic events or trends in those countries. In conclusion, while cross-currency pairs may involve higher transaction costs due to their lower liquidity, they offer an alternative route to diversify your trading strategy. They provide access to different economic dynamics and can be a good way to spread risk across various currencies. Though they may involve higher costs, cross-currency pairs can still offer valuable trading opportunities. In Forex trading, margins and leverage are tools that can amplify your trading capacity. To understand how these tools work, let's first define them. A margin is essentially a good faith deposit that a trader makes to hold open a position. Now, you might be wondering, why would you need to deposit anything? Well, in the world of Forex, you're essentially borrowing one currency to buy another. The margin is your assurance to the broker that you can cover the loss if the trade doesn't go in your favor. Now let's move on to leverage. Imagine you want to lift a heavy object. You could try lifting it directly, or you could use a lever to make the task easier. In the Forex market, leverage acts as that lever. It allows you to control a larger position with a smaller amount of capital. Here's an example to illustrate. Let's say your broker offers a leverage of 100 to 1. This means that for every dollar of your own money, you can trade $100 of a currency pair. So with just $1,000, you could potentially control a $100,000 position. It sounds great, doesn't it? But remember, while leverage can magnify your profits, it can also magnify your losses. If a trade goes in your favor, your return on margin is significantly higher than your initial investment. But if the trade goes against you, you could end up owing more than your initial deposit. So it's essential to use these tools wisely. One way to do this is by managing your risk. This could mean setting a stop-loss order to limit potential losses, or not using the maximum leverage offered by your broker. Margins and leverage, if used wisely, can be powerful tools in your trading arsenal. They can amplify your profits, but they can also amplify your losses. Therefore, it's crucial to understand how they work and to use them responsibly. And there you have it, a comprehensive breakdown of Forex trading terminology. We've journeyed through the world of major and minor currencies, understood the pivotal role of base and quote currencies in a trade, and delved into the details of pips and pipettes. We've navigated the terrain of bid, ask, and spread, grasped the implications of transaction costs and quote conventions, and explored the distinctive characteristics of cross-currency pairs. Lastly, we've tackled the concept of margins and leverage, revealing the potential they hold to amplify both rewards and risks. Each of these terms plays a vital role in your trading strategy, shaping your decisions and ultimately your success in the Forex market. It's a complex landscape, but with knowledge and understanding, it's one you can navigate with confidence. That concludes Lesson 6. Your next step? Dive into Lesson 7. Forex order types explained. Until then, keep learning and happy trading.